Hello, I'm Abhilash Narayan, investment strategist at HSBC. This is the latest edition of India Brief, where we discuss our house views about Indian equities and fixed income markets. India's economic growth has been caught in a tug of war. While the imposition of 50% US trade tariffs has the potential to dent India's growth by 0.7% over the next year, we are also encouraged by the recent upside surprise in Q2 GDP data and the recent announcement by the government to rehaul the goods and service tax or GST regime, which has the potential to not only boost short-term domestic consumption but also uplift India's long-term growth. Additionally, high-frequency economic indicators continue to point towards robust economic momentum. We also think that the monetary policy is likely to be supportive, as the downside risk to growth and the undershoot of inflation means that RBI is likely to cut rates by 0.25% in Q4 of 2025. So what does all of this mean for financial markets? Well, firstly, we are bullish on INR local currency government bonds. We believe that the recent rise in yields after the announcement of GST overhaul has been overdone and actually presents investors with an attractive opportunity to add exposure to bonds at elevated yields. In our assessment, the impending RBI rate cuts and the ultimate resumption of foreign inflows once the geopolitical risks subside means that 10-year bond yields should head lower in the coming months. However, we take profit on our overweight on Indian equities and trim the positioning to neutral. While Indian equities continue to be supported by robust economic growth, strong domestic consumption, and their low correlation with global equity markets, we believe that their probability of outperforming global equities has reduced given the elevated valuations, the weakness in sentiment given the trade tensions, and the softening of earnings momentum. Within Indian equities, we have a preference for large cap stocks. From a sectoral perspective, we prefer sectors which are more domestically oriented and hence should be more resilient. We are overweight on financials, healthcare, consumer discretionary, and industrial sector.